As we close out 2023, we are getting a lot of questions on what we think about 2024. There are a lot of short-term issues that are facing the US markets, whether it's war in Israel, strikes, possible government shutdown, the Fed hiking cycle and when it is over, the impact on student loan repayments on the consumer. Will inflation peak or has it already peaked? These make for an uncertain short-term market environment. But when we get into 2024, we should have a lot more clarity on all of these issues, and most importantly, what do these issues mean to earnings and corporate profits in 2024? Although there are some headline uncertainties facing the US market, there are plenty of opportunities, especially when we look at certain asset classes. Take for high yield, for instance. Right now, the current yield in the marketplace is over 9%. If you look at the forward returns of the high yield market under that scenario, if you look back to history, history shows that it's very possible for 2024 to have mid to high single-digit returns for the asset class. Convertible bonds is another asset class that can provide an exciting opportunity for 2024. Right now, the market is more yield-oriented or defensive, meaning similar to high yield, you're going to get that yield price appreciation. What that means is that investors can capture that upside from that yield or price appreciation from the movement of the underlying stock, but they also get downside cushion as many of these bonds are closer to their bond floor. When we look at the broad themes of the market, there are plenty of sector opportunities. If we look at technology, for instance, there's the possibility of playing artificial intelligence, semiconductors, cybersecurity, software as a service. If we look at other sectors, you can look at consumer discretionary, where defensive plays could be a possibility. If you look at the industrial sector, there's industrial automation, there's onshoring, there's aerospace and defense as possible opportunities. And if you look at the healthcare sector, that has been one of the most challenging sectors in 2023. So as earnings bottom in that sector, that can be an opportunity set for 2024. Currently, the short-term setup is a little cloudy. We have many things facing the market that provide uncertainty, whether it's war in Russia and Israel, whether it's possible government shutdown, whether it's student loans having to be repaid, whether it's interest rates continuing to move higher, whether it's bank lending getting more challenging. These are the headlines that we see every day. The most important thing to watch is, are these issues going to impact corporate profits? Currently, what we've seen from third quarter earnings season so far is that these issues aren't necessarily impacting earnings. And that's going to be the most important thing to watch for 2024. Typically, if the Fed is easing, what you see is that corporate profits begin to move higher, companies begin to spend again, and history shows that that's a great part of the market to be invested in. If that does happen in 2024, it's possible that much of the cash that's sitting in short-term investments could move into asset classes such as high yield, investment-grade bonds, convertible bonds, and even equities. So again, if we look to history as a guide, if the Fed starts easing, what we really want to focus on is, what is the impact to corporate profits? And more importantly, does that allow companies to invest in their growth again? Because ultimately, growth drives profits. A multi-asset fund that utilizes high-yield bonds, convertible bonds, and equities with covered calls can provide investors income, participation on the upside, and downside cushion. When we think of the high-yield asset class, where the current yield in the marketplace is 9%, that's a great return for an individual investor. Likewise, the convertible asset class can provide investors upside participation, coupon, and downside cushioning. If we utilize a covered call strategy, That will help dampen the volatility of an overlying equity portfolio. Putting those three asset classes together again can give the client income, participation, and more importantly, downside cushioning.